many of these founder-led companies have done extremely well for us, and we've gone on the journey from when they were very small, and now they're in the large cap index. We've seen about a 10% outperformance versus the market for a cohort of founder-led companies. We were the largest IPO investors in Afterpay. We also left a lot on the table.
I was going to say, did you hold through? What are some of the biggest investing mistakes that you've made?
How long do you have?
Yeah, how many scars are you going to reveal?
Hero or sidekick?
Welcome to Sidekick, the podcast where we uncover the hidden superpowers that drive some of the biggest, fastest growing companies and most successful names in the business world. I'm Bryce and I'm joined by my regular co-host and my trusty sidekick, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. If you think about some of the biggest, most successful, most exciting companies that we've covered over our journey of hosting Sidekick and of producing Equity Mates, one thing that stands out is a lot of them are these founder-led companies that start with an idea, go through a startup, and then become some of the big public companies that we know today. And the expert that we're speaking to today is running a fund that's purely focused on finding these founder-led companies. Tobias Yao, welcome to Sidekick.
Thank you for having me. Very excited to be here.
So Tobias is portfolio manager at Wilson Asset Management for their Founders Fund, which, as Alex said, focuses on companies that are founder-led. And throughout this episode, we are going to be looking at how founder-led companies have that superpower. So to start off today, Tobias, we want to unpack your investing philosophy. Introduce us to the concept of a founder-led business.
Yep, sure. So Wilson Asset Management was founded in 1997 by our founder, Jeff Wilson. And so we currently manage around $6 billion on behalf of 130,000 shareholders. And the investment approach has always been very consistent through that journey, which is to find undervalued growth companies with catalysts that we need to find that could re-rate the share price of these companies over the medium to the long term. And a catalyst could be effectively an inflection point in the journey of this business over time, acquisitions, etc., that could supercharge the growth of the business. Now, in March, we launched a new strategy, and the new strategy is effectively to apply this investment approach, but narrow it down to only investing in ASX and sort of New Zealand-listed founder-led companies, and really just picking a group of 30 to 40 companies that we really like. You know, we know the management teams really well. We've had a long history, and really just going on the journey with these guys. You know, I think one of the benefits for us is over my investment journey at WAM, which is the last 11 years, we've owned over, I think, 1,100 different companies, active positions. So what we've found is that many of these founder-led companies have done extremely well for us, and we've, as you said, gone on the journey from when they were very small. In many cases, actually went into the mid-cap index, and now they're in the large cap index, much larger businesses. So, you know, we feel like we have a very good mental model on identifying these type of companies, and we're trying to really apply that methodology and the mental model to find this new cohort of, you know, founders that we want to back over the next 10 years.
Nice.
Now, we imagine that you are selecting on founder-led because
Yes.
it's the thesis is that they'll outperform the regular market. So what does the data tell us? What does history tell us? What is like the founder-led performance cap?
I think prior to launching the fund, we did quite a bit of work last year to analyze, I guess, founder-led companies on the ASX. And so the data is about, depending on how you cut it, in terms of insider ownership of companies, we've seen about a 10% outperformance versus the market for a cohort of founder-led companies. And when we analyze the data for IPOs, so the last sort of IPO cycle between 2013 and 2020, the alpha has been about 10% per annum as well. So that's been, you know, very strong for us. But when we look at the performance of our funds, so the 4 listed investment companies that we manage as a team, you know, when we have done an attribution analysis, the founder-led companies contributed to about 2/3 of total performance over the period, even though they were around 20% of the holdings. So they've really given us an outsized performance over a very long period of time. And actually, through various market cycles. As you know, the market's very volatile.
Well, what is it about founder-led businesses that you think contribute to that outperformance? What are the key sort of characteristics?
Yeah, so the disclaimer here is this is not exclusively just to founders, but a lot of CEOs, CFOs, we see that within their businesses as well. And it's probably more our experience over the last decade that we seem to more regularly see these traits in the founder companies. And I would talk about three key characteristics. The first one is obsession, like the positive kind. And I just wanted a word that's higher than passion, because these guys and girls are obsessed about driving every aspect of the business. And, as institutional investors, we're very fortunate to be able to have access to many of these founders. You get to pick their brains on how they see the company evolve over time, how they run their business. And so that obsession, you can almost feel it, when we meet these businesses and meet these leaders.
And if I can just interrupt you there, in a previous episode of Sidekick, we interviewed Stephen Marks from Guzman y Gomez, and I think he embodies that obsession. No one cares more about a chicken burrito than that guy.
I've met Stephen, that's exactly right.
Yeah.
And I think all these founders, we keep seeing the same traits across all the successful founders, different industries. I mean, there's no cookie cutter approach to the perfect founder. It's all very different. It's all relative to their competitors in the industries. But that obsession, you can just feel it, and the sort of the relentless focus on just perfecting every part of the business. The second characteristics for a founder-led company, in our view, is simplicity. Founders like to keep things very simple. So for customers, it's a very simple service or product proposition, simple organizational structures. There's not a lot of red tape. And the way they run the business, they just think about the key drivers and really ensure that the entire organization is, structured to keep pushing, in the one direction. So, we find that simplicity actually helps these businesses in the public markets because over time, investors gravitate towards simple business models, simple thematics as well. So then these guys get the best re-rate in the share price. And finally, the final characteristic is around having a very strong team around the founder, someone they mutually respect and can bounce ideas off each other and mitigate each other's sort of flaws and sort of complement each other's strengths as well. And I think having that team around the founder really helps ensure the longevity of the business model and the success that they've had. So we see very strong teams around some of the founders that's really succeeded, and the founders, listen to the CFO, listens to the head of products, the head of tech, and they really work together really well as a team.
How, I guess, would you define founder-led? Because I guess there's a lot of businesses that perhaps still have the founder involved, but maybe not in an executive capacity, or there's examples, like Nick Scully Furniture being an example where it's like multi-generation, where it's now the son who's running the business. So what are your parameters in the fund for what constitutes founder-led?
So in terms of what qualifies as a founder for us, they need to hold an executive position. So it has to be either management or on the board. They either need to have over 10% of the company or $20 million in equity. So this ensures that some of the smaller companies or some of the larger companies that they still qualify, and it's about 20% of the ASX All Ords that when we went through the analysis, tick the criteria box.
That's surprisingly high. I wouldn't have thought it would be that high.
Yeah, it's actually higher than we thought, and obviously outside of the All Ords in the small cap space, there's a lot of companies that's sort of founder led as well.
Yeah.
And but it's it's just one parameter that we're looking at. We're not investing in every founder company.
No.
In fact, some of the high quality founder companies we have invested in primarily because we don't really have an edge or we don't have the history with the business. So it's not because it's not a great company. It's just that as investors we have to sort of pick our lanes. And so there's actually quite a lot of companies like that, and it really helps us filter the investable universe in the sort of the wild west of small caps.
It's interesting because a lot of the characteristics you spoke about there, focusing on what the growth drivers of a company, trying to keep business models simple, like those are characteristics that you would expect any manager,
Yes.
regardless of founder, to kind of embody and sort of carry through. But really it sounds like the difference is just incentive driven now because you actually own a fair chunk of the business. Like, is the incentive structure really what you think drives the difference here?
Yeah, absolutely. I think the observations that we have, it's probably around the small cap space. So companies where if they succeed, they go through a period of hyper growth. And with founders, they're stuck in the position. So when there's an issue in the business, they have to sort it out. Versus, when we see management, sometimes, they have a 3-year contract, a 5-year contract. So perhaps they're not making these really long-term decisions. And so for them, it's a different time frame into how they run the business. And, as investors, so our founders fund, it's a buy and hold for the long term and really backing some of these founders over the long term. And so we want the same alignment. And, as our investors want alignment with the fund manager to co-invest our own money and own capital into the fund, we sort of want this to trickle through to the founders, obviously with their own capital in the underlying assets. So for our investors, there's a bit of a see-through alignment of interest across the different capital stacks.
Yeah. So let's bring this thesis to life with a couple of examples, and maybe let's start with an historical example, and then we'll fast forward to the fund today. But give us an example or two from ASX history that really illustrates this like founder-led thesis.
Yep. I mean, one that's I'm sure everyone knows about is Afterpay.
Yes.
Nick Molnar and Anthony Eisen. So we were the largest IPO investors in Afterpay. And in some of these names, it's a bit of a pat myself on the back, they're the best performers for us, but we also left a lot on the table.
I was going to say, did you hold through?
we held a decent position, but then as the position size got larger, we had to take profit.
True. Yeah.
And so these are the best things to ever happen to us, but also we left a lot on the table, and it still scars us to this day, actually. But Ant and Nick, when we first saw them, so I saw them present the BNPL, and they obviously not only created a very successful business, but perhaps an industry. And so at the time, for us, we obviously debate about investment ideas, but what we like to do more often is to find tangible evidence of something working or something that's not working. So I distinctly remember when they were going through the IPO process. Obviously, we were very impressed with how they pitched the business. But I went to speak to a friend of mine at the time, who's Jane from Shilpo, and I remember she created a very amazing online fast fashion business. And I said, "Hey, Jane, have you heard of this Afterpay sort of model?" And she said, "Oh yeah, I've actually switched from someone else to Afterpay, and it's working extremely well for me." And given her digital expertise, I relied heavily on that one piece of data, as well as a few other retailers that we've spoken to really go hard into the Afterpay IPO. Ant and Nick, their focus is, their obsessions on, one of their obsessions is on driving customers. They understand their customers really, really well. They understand the retailers really well. And it's all about adding new retailers, adding new customers. And that's something that really differentiated them from many of the other iterations of the buy now, pay later players that try to, copy them. Another company is a company called Temple Webster. Mm-hmm. So I'm trying to remember, we initiated a position around 40 cents when the founder, Mark Coulter, came back into the CEO role, and Mark Taylor was the CFO. And the first couple of years wasn't actually very easy. I mean, in the fullness of sort of time, it looks like a pretty simple model, but back then they had to consolidate 3 businesses, fix the business, streamline the business before they could grow. So the first couple of years, the revenue sort of, from memory, was flat. And then they got on the flywheel, and then all the scale advantages were coming through, and they started growing. But both Marks, they're very focused on data. And so it's amazing to see, obviously how the size of Temple Webster now, but we always think that they sort of a category killer for homeware and furnitures, and now they're going to home improvement. So really leveraging off the scale. As they grow larger, their competitive advantages improves, and then they sort of reinvest that into further growth. So just a couple of examples that's really done really well for us over the years, but also, again, left a lot on the table along the journey.
Well, if you turn to today, what's one of the larger positions currently in the fund that is representative of the philosophy?
So the largest position in the fund is a company called TPG Singapore. So we've been there since 2021. The founder and it's listed here on the ASX, the founder for Tuas is the same founder as TPG Telecom in Australia, David Teo. The amazing thing is, I remember when I was at university a long time ago, all of my mates bought TPG Telecom shares. Yeah. And the share price did incredibly well. And I remember telling myself, if David ever did something similar,
go for it.
I'm going to back him.
Yeah.
And he has this sort of, and then he's running this business in Singapore with the CEO, Richard. And they've done an incredible job going into the country as the fourth mobile operator. His focus on product innovation, engineering, and efficiency gave them this massive advantage on launching products that none of their competitors could match. So when they first went into Singapore, they were offering $10 for 80 gigabytes of data, and this is 3 years ago, versus, I think, from memory, their peers were offering $10 at 3 gigs of data.
Yeah, wow.
And a lot of that is through the ability of the network which he created and he obsesses about that gives them the advantage. So there's a company in India which is called Jio, not the same business, but they entered the Indian market in 2016 from zero, and they got to 43% of the market share in India in 9 years' time. So TOA is about 4 years in, and they're about 12% of the market share. And not trying to compare the two, but when you have a really good model, it's working and it's really disrupting the incumbents. We believe that these businesses can continue to scale. And the good thing with David, and often, I think he's underrated. He's probably one of the best telco entrepreneurs in the world. But unlike, we see this across a few founders, they don't talk up the share price. It's a very simple presentation.
Well, to be honest, he doesn't talk up anything. Part of the reason he's underrated is he doesn't come on podcasts like this.
But he owns 40% of the company, and so he doesn't need to, try to talk up his story, and he's he focuses on just running the business. So that we really admire these traits of some of these founders.
It's one of my favorite investing books is The Outsiders, and it profiles 8 CEOs who just have had incredible share price performance, created incredible wealth. And one of the common themes amongst them all is that they just didn't talk their own book. They let their business do the talking. They didn't have an investor relations department, a lot of them. And he seems like another example of that, where he's like, buy my shares or don't buy my shares. Let time decide.
Exactly. Absolutely. And we really admire that, and we see this across a lot of these companies as well. So it makes our jobs a lot easier.
Well, unless you want to try and talk to him and get some information, and then it might be a bit harder.
That's impossible, actually.
So for people listening at home who are thinking about investing in founder-led companies, are there any additional rules of, portfolio construction that you apply to the fund when you're thinking about investing in this specific subset of the market?
Yep. So we're definitely not investing in every single founder-led companies. As an investment team, we try to not stand still, because if you stand still, you're going backwards. But we try to evolve the way we think about these businesses. So having a founder lead the business is important, but it's just one aspect. We think a lot about how the core competencies of these businesses evolve into competitive advantages, and more importantly, how does that evolve over time? So is it getting stronger or is it getting weaker? And then we try to compare these businesses to the competitors and compare the management teams of these competitors to obviously this founder-led company that's trying to, in most cases, disrupt the status quo. So, we do a lot of on-the-ground research, and as institutional investors, we have the advantage of being able to keep retesting our thesis. And obviously, if you're onto a really good stock, we want to make sure every 3 to 6 months that we're making sure that they're staying on track. What's also important to us, and I think something retail investors potentially could think about, is we need to identify our edge in every single position. So, for TPG Singapore, Oscar and I, we've gone to Singapore probably every 6 to 9 months every year for the last 4 years, and we've spoken not to us, but all the competitors, and having multiple meetings with consultants, and the M1, Singtel, StarHub, which are effectively the Telstra, Optus, and Vodafone of Singapore, and our edge, therefore, in our view, is having done more work in terms of the competitor set. So I think for a lot of the retail investors, sort of backing a founder is great and following the track record, but in many cases, if they work in a specific industry, they have an edge. They have a better understanding of that business or that industry, and they could apply that edge in picking stocks as well. So I think that's quite important.
Now, with founder-led businesses, there is a lot of good, but not often, but there are cases of it coming with a bit of baggage as well. And I think there have been some notable stories in the past 12 months where we've really seen this play out. Chris Ellison at Mineral Resources, Richard White at WiseTech. What are the lessons that we should take from these two examples?
It's really funny because when we were pitching the fund, those were the two tickets that every meeting we had to answer this question, but it's good. And I'll give you the same answer. So we weren't investors when the press occurred. So I guess from our perspective, we were just reading the papers like everyone else, and we didn't have any additional insights. But what I would say is, depending on when you became a shareholder for WiseTech or MinRes, and if you were like one of the early shareholders, you have done incredibly well for a very long period of time. In fact, I think WiseTech is a stock we never invested in, and it's sort of impacted me to this day in terms of
a lot of scars, Tobias.
A lot of scars. I think after 1,100 different companies, there's just so many scars. It's not just scars, but bullet wounds, and I think for us, we're looking for, I guess, companies that's small. And hopefully the focus for the founders for those initial years are there to obviously generate that outsized performance. And, our fund's all about trying to maximize capital growth. I think the simplest thing someone could do is follow the money. So we have a rule within our fund, which is if a founder sells more than 25% of his or her entire stake in a 12-month period, we'll sell the position to zero. And that comes from some of the experiences we've had over the journey, scars. And we don't mind sell downs. Like a lot of the founders in our Founders Fund, they do regular sell downs, and it's very orderly. And so we participate in these sell downs or buying into these sell downs, and have done actually extremely well having bought these sell downs. And it increases the liquidity of the business, gets more new shareholders onto the register, and therefore it's actually a positive thing. But it's usually when they sell a huge stake in a very short period of time that concerns us, because we don't know what's going on beneath the surface. Another red flag would be if things become too complicated. So if you think about a business, with their core competencies or the business model, if they start to acquire things that's outside of their, strengths, or something that's non-core, that would distract, I think, not only the founder but the management team, and typically that's a red flag for us as well. And so, these are a couple of things I think investors can, look out for.
I think that's a good rule of thumb. To sell 25% within 12 months, and you're just out.
I'm out.
No ifs or buts. Yeah. So I mentioned Nick Scarley earlier, but we wanted to pick your brain on succession planning, because Nick Scarley isn't the only example, with Anthony Scarley now running it. And I guess even he's getting a bit old, and you're starting to think about the next generation. But I guess Kerry Stokes and Seven Group is probably the other really notable one, with Ryan now running the show. How do you think about succession planning? How will you approach it in the fund? How do you sort of assess whether the kid is going to be able to continue the success?
Yeah, it's a very, very interesting question. We think about this quite a lot. And we have as institutional investors, we have the ability to meet with not only the CEO, CFO, the chairman, but we get to meet the sort of the next level of managers and be able to assess, how good they are. And it's not just, Nick Scully and Seven, they've done incredibly well, but when we look at some of the CEOs that's come out of founder-led companies, so Ed from Technology One worked with the founder for a very long time, Adrian, and Cameron from Car Sales worked with, I think, Greg for a very long time. We often find, that founders, it's a long journey because you got to start a business, hire 10 guys, then try to scale domestically, scale internationally. Often founders, get to a certain stage, they have different priorities in life. But then the new sort of managers that's coming through the organization might have a different skill set to them that could successfully scale the business even to newer heights. So if you looked at Technology One and the share price performance, after Adrian's taken a step back and after Greg's taken a step back, they've all gone up really well, and the new CEOs have done incredibly well. Heavily invested in the business, pretty much live and breathe the business, the same DNA, but having that additional skill set to really take the business further. And so we think it's not necessarily a bad thing if they can find the right talent to take them there. Ryan has done incredibly well with Seven. I think it's up 10 times in the last 10 years. So, and Anthony as well. So it's not always a bad thing when they step back a bit and let the new person come in. They're very hungry and they come in and they really sometimes take the business to the next level.
So for some of those examples where it's a manager CEO who may have been on the journey for a long time, are you looking for those CEOs to have similar alignment, or as long as the founder sits on the board still, that's okay?
Absolutely. So in those two cases, because they've both been in the business for such a long time, the equity stakes they have in the business is actually quite high and actually fits our hurdle. And so we're happy to invest behind these type of businesses as well.
Yeah, okay.
So you've spoken to a lot of founders.
Yep.
For any budding founders that are out there hoping to one day be a holding in your portfolio, what advice would you give to those looking to build those enduring investable businesses?
So this would be paradoxically, my advice would be don't listen to any investors about how to run their business. Nice. I tried that once. I think in 2017, there was a founder-led company. There was a bit of market volatility, and I was a much younger investor back then. I'm like, in the most respectful way, hey, this is what you need to do. Luckily, the founder didn't listen to me, and the share price is significantly higher. And we still joke about it to this day. And I've vowed, I think it was 6 months into it, to never give any advice on how sort of they should run their business. We provide obviously advice on how how the market works and what are the best ways to message the market to realize the intrinsic value for these businesses. But I'm never making that mistake again, and to provide advice. So my advice would be don't listen to investors.
Nice.
Just nod and smile.
Just convince them to invest.
But I think for potential IPO founders, I would say, IPO is a really good market. If it's done correctly, and I think there's a lot of negative press on the overall initial public offering. It's been pretty benign for a couple of years. I've spoken to a lot of founders that hasn't listed their business, thinking about listing. The advice has been, look, if you want to list, you should, in a way, corporatize like a lot of the reporting, a lot of the structures. So preparing yourself to be a listed business and having that set in place early. If you have an aspiration to list in 5 years' time, you have to be able to pull the trigger in 3 or 7 years because the market, depending on the timing. So if you're not ready, when the timing, when's the right time, you just have to pull the trigger and go to the market. And you just have to be very prepared. I think the IPO market is actually a very good market, potentially for founders, where you retain control of the business, and then you can access capital and access shareholders with that longevity. But they'll have a certain time period where the fund closes, so therefore you have to then sell the entire stake to someone else. But if you have a listed business, these shareholders, will stay on for a very long period of time, like a lot of the retail shareholders. So it's quite important for these founders to understand, I guess, the benefits of an IPO, not just the burdens, so the added compliance, etc. So there's always, it's a double-edged sword.
Yeah. So you've invested in a lot of founder-led businesses over your time. Well, a lot of businesses, full stop, over 1,000, as you said earlier. What are some of the biggest investing mistakes that you've made, and what were the lessons that you learned from them?
How long do you have?
Yeah, how many scars are you going to reveal?
The one that stands out is a company that does videography hardware, Atomos.
Atomos. Yeah.
It was a founder-led company. The founder was actually very good in terms of creating products, and I think he's an engineer and the inventor. Obviously, created a product, did really well. The mistake we made was when he suddenly exited the business and sold his entire stake. We didn't sell out. We still had like half a position, and the stocks sort of then unraveled very, very quickly. And I think, again, this goes back to following the money, and again, like the investment thesis for this new fund is to, when you have those scenarios, to just cut your losses. The technology is really good, but it is a complicated business with customers around the world. So you needed the sort of the financial rigor around managing the business, managing the working capital cycle, the customers, and in that case, that's probably being one of the biggest mistakes we made. I guess when you have a big position, you keep having this anchoring bias, and you go, "Oh, he's left," but he's left the business in a really good, not quite the case. So that's being a mistake. But we as investors, it's my fault. It's not really the founders. We have to learn from these mistakes, and as make a lot of mistakes all the time. So, but it's my fault to have invested in the business, and they just have to learn from it.
Yes, nice. Well, Tobias, to close today, are there any emerging founder-led businesses that you're watching closely, even if they're not currently in the portfolio?
Yeah, so I'm typically more growth and tech, but so I'm trying to think of a growth and tech.
We're happy with growth and tech.
It's a growth company, but non-tech. Okay. So there's a company called Genus Plus. I'm not sure where the listeners have heard. The founder owns more than 50% of the company, so they are a engineering and construction business out of Perth, still relatively small. So they benefit from the rise of renewable energy assets and investment in renewables, and they benefit from Rewiring the Nation, the initiative where effectively, if you think about Australia a few years ago, electricity came from a few coal-fired power plants. Now it comes from solar farms everywhere, wind farms. And so the transmission line to be able to handle the burden of electricity within the country, it's really not fit for purpose. So there's a huge initiative and a lot of billions of dollars being spent now to try to build new transmission lines and effectively allow for the different sort of power plants to feed electricity into the grid. So Genus Plus effectively is one of the 2 Australian-owned businesses that has done an incredible job building these transmission lines and the battery storage, etc., on behalf of renewable energy companies and on behalf of governments. So the business has been growing really well, super profitable. The valuation is very cheap, and the founder owns over 50% of the company, and it's an amazing founder. It's, again, the son of the original founder, but he's really taking it to new heights as well.
Wow.
Nice.
Well, I'd never heard of it, but I just looked it up 200% since listing about 5 years ago.
Yes.
So
solid.
Not bad.
Can't
complain about that. Well, Tobias, we've loved this conversation. We've loved learning more about founder-led businesses and how they can be a superpower for some listed companies. I'm sure we'll speak again, but until then, thanks for joining us.
Thank you very much.
Thanks, Tobias. And if you're interested to learn more about how you can grow your wealth like a superhero, head to superhero.com.au/invest.
That's it from us today, your trusty Sidekick. Subscribe to Sidekick wherever you're watching or listening so you don't miss an episode. We'll be back next time uncovering more superpowers.